Before investing in shares, it's important to understand what they are, why people buy them, and the risks involved. Because while shares have created enormous wealth for many investors, they can also be volatile and sometimes lose significant value. Let's start with the basics. A share represents a small ownership stake in a company. When you buy shares, you become a part owner of that business. If the company grows, becomes more profitable, or investors become more optimistic about its future, the value of those shares may increase. Some companies also pay dividends, which means they share part of their profits with shareholders. This means there are two main ways investors can make money from shares. First, through capital growth, where the share price rises over time. Second, through dividend income, where the company pays a portion of its profits to shareholders. Let's look at a simple example. Imagine you buy shares in a company for $1,000. Over time, the company grows and the value of your shares rises to $1,500. You now have a $500 capital gain. If the company also paid dividends during that period, you would have earned additional income while still owning the shares. This combination of growth and income is one reason shares have become one of the most popular long-term investments. But shares are not without risk. Share prices can rise quickly. They can also fall quickly. A company can lose customers. Profits can decline. Management can make poor decisions. Competition can increase. Economic conditions can change. And sometimes investors simply become less willing to pay high prices for a company's future earnings. This means that even good companies can experience significant price declines. One of the biggest mistakes new investors make is believing that shares only go up. History shows us that markets regularly experience corrections and bear markets. Sometimes share prices fall 10%, sometimes 20 to 40%, occasionally much more. The key is understanding that short-term volatility is normal. For long-term investors, market declines are often the price paid for higher long-term returns. Another risk is concentration. Imagine putting all of your money into a single company. If that company succeeds, your returns could be excellent. But if the company struggles, your investment could suffer significant losses. This is why many investors spread their money across multiple companies, industries, and countries. Diversification doesn't remove risk, but it can reduce the impact of any single investment going wrong. So why do investors continue buying shares despite these risks? Because over long periods of time, shares have historically outperformed many other asset classes. Businesses create products, provide services, generate profits, and often grow as economies expand. As shareholders, investors participate in that growth. This is one reason many retirement funds and long-term investment portfolios hold a significant allocation to shares. However, successful investing in shares requires patience. The goal is not to get rich next week. The goal is to allow time for businesses to grow and for compounding to work in your favor. For example, if a portfolio grows at an average of 8% per year, it roughly doubles every 9 years. The longer you remain invested, the more powerful compounding becomes. That doesn't mean every share will succeed. Some companies fail, some never recover, and some investments simply underperform expectations. That's why research, diversification, and risk management remain important. Before buying any share, ask yourself, do I understand what this company does? How does it make money? Why do I believe it will be more valuable in the future? And what risks could cause my investment to lose value? The more clearly you can answer those questions, the more informed your investment decision becomes. Shares can be a powerful wealth-building tool, but they are not a guaranteed path to riches. They require patience, discipline, and a willingness to accept short-term volatility in pursuit of long-term growth. Because successful investing isn't about predicting tomorrow's share price. It's about owning productive assets that can create value over many years. Buy assets, build income, reduce risk, create options. This video is for general educational purposes only and should not be considered financial advice. Always do your own research before making investment decisions.